Question 1. Research into the management of customer collateral by a retail foreign exchange dealer, RFED, registered in the United States reveals a situation where a customer's account has fallen below the required margin level, creating a temporary shortfall in the segregated customer funds. Which of the following represents the most appropriate and compliant course of action for the RFED? Option A. Immediately cover the shortfall using the RFED own capital to ensure customer segregated accounts remain fully funded. Option B. Transfer funds from another customer's account to temporarily cover the shortfall in the affected account. Option C. Record the shortfall as an unsecured debt owed by the customer and address it at the end of the trading day. Option D. Acknowledge the shortfall and wait until the next business day to rectify it, assuming market conditions stabilize. The correct answer is A. Immediately cover the shortfall using the RFED own capital to ensure customer segregated accounts remain fully funded. Explanation. This scenario is professionally challenging because it requires a clear understanding of how a retail foreign exchange dealer RFED in the United States must manage customer collateral to ensure compliance with National Futures Association (NFA) regulations and protect customer assets. The core issue revolves around the proper segregation and accounting of funds received as security deposits or margin, which are not the dealer's capital, but rather customer property. Careful judgment is required to distinguish between the dealer's operational funds and customer segregated funds, especially when considering potential shortfalls. The best professional practice involves immediately identifying and rectifying any shortfall in customer segregated accounts by using the RFED own capital. This approach directly addresses the regulatory mandate under NFA Rule 1.17 and CFTC Regulation 1.17, which require RFED to maintain adequate capital and segregate customer funds. By using its own capital to cover the shortfall, the RFED ensures that customer accounts are not depleted and that the required segregation of customer property is maintained at all times, thereby preventing a violation of customer protection rules. An incorrect approach would be to cover the shortfall by drawing from another customer's account. This is a severe regulatory and ethical failure. It directly violates the principle of segregation, treating one customer's assets as security for another's position, which is prohibited. This action would constitute commingling of customer funds and a misappropriation of customer property, leading to significant penalties and loss of trust. Another incorrect approach is to delay addressing the shortfall until the end of the trading day or the next business day. The intention might be to avoid immediate disruption. This delay still results in a period where customer segregated funds are insufficient. This constitutes a breach of the continuous segregation requirement and exposes customer assets to risk, violating the spirit and letter of NFA and CFTC regulations designed to protect customer funds from being used for the dealer's operational needs or other customer obligations. Finally, an incorrect approach is to simply record the shortfall as an unsecured debt owed by the customer. Customer margin and security deposits are not unsecured debts. They are specific assets held in trust for the customer. Failing to segregate these funds properly, even if recorded as a debt, means the funds are not available as required by regulation, and the RFED is not meeting its capital and segregation obligations. This demonstrates a fundamental misunderstanding of the nature of customer collateral and the regulatory framework governing its management. Professionals should employ a decision-making framework that prioritizes immediate compliance and customer protection. This involves 1. Proactive monitoring of all customer segregated accounts to identify any potential shortfalls in real time. 2. Establishing clear internal procedures for addressing shortfalls, with the immediate use of the firm's own capital as the primary and only acceptable solution. 3. Regular training for all relevant personnel on NFA and CFTC regulations concerning customer funds and segregation. 4. Seeking guidance from legal counsel or compliance officers when any doubt arises regarding the proper handling of customer assets. Question 2. Which approach would be most compliant with U.S. Commodity Futures Trading Commission, CFTC, and National Futures Association, NFA, regulations when a firm is determining whether a prospective client engaging in off-exchange Forex transactions should be classified as a retail customer or an institutional client? Option A. Accepting the client's self-declaration of being an institutional investor without conducting any independent verification or due diligence to confirm their status. Option B. classifying the client as an institutional investor solely based on their stated intention to trade significant volumes of Forex, without further investigation into their specific financial standing or business operations. Option C. Accurately assessing the client's status by applying the objective criteria outlined in CFTC Rule 1.3 and NFA Interpretive Notice 03-09, which consider factors such as the client's financial sophistication, assets under management, and whether they are an individual or an entity, to determine their eligibility for retail customer protections. Option D. Designating the client as a retail customer simply because they are an individual, irrespective of their trading experience, financial resources, or business activities. Correct answer is C. Accurately assessing the client's status by applying the objective criteria outlined in CFTC Rule 1.3 and NFA Interpretive Notice 03-09, which consider factors such as the client's financial sophistication, assets under management, and whether they are an individual or an entity, to determine their eligibility for retail customer protections. Explanation: this scenario is professionally challenging because it requires a clear understanding of the distinction between a retail customer and an institutional client within the context of off-exchange Forex trading in the United States, as governed by the Commodity Futures Trading Commission, CFTC, and the National Futures Association, NFA. Misclassifying a client can lead to significant regulatory violations, reputational damage, and potential financial penalties. Careful judgment is required to ensure that all clients are treated according to the appropriate regulatory framework. The best professional practice involves accurately assessing the client's status based on objective criteria defined by regulations. This approach prioritizes compliance and client protection by ensuring that individuals who meet the definition of a retail customer receive the protections afforded to them under CFTC Rule 1.3 and NFA Interpretive Notice 03-09, such as margin requirements and disclosure obligation specific to retail Forex transactions. This ensures fair dealing and prevents sophisticated entities from being subjected to regulations designed for less experienced retail participants, while also ensuring retail participants receive the necessary safeguards. An approach that assumes a client is institutional solely based on their stated intention to trade large volumes, without verifying their eligibility under regulatory definitions, is professionally unacceptable. This fails to adhere to the objective criteria for institutional status and risks treating a retail customer as an institutional one, thereby denying them the regulatory protections they are entitled to. This constitutes a failure to comply with CFTC and NFA rules regarding client classification and the provision of appropriate disclosures and risk management. Another professionally unacceptable approach is to classify a client as retail simply because they are an individual, regardless of their sophistication or the nature of their trading activities. While many retail customers are individuals, the definition of a retail customer is more nuanced and considers factors beyond mere individual status. This approach oversimplifies the classification process and could lead to sophisticated individual traders being subjected to regulations not intended for their level of experience, potentially hindering their trading activities unnecessarily. Finally, an approach that relies on a client's self-declaration of being an institutional investor without any independent verification or due diligence is also professionally unacceptable. While a client's assertion is a starting point, regulatory bodies require firms to have robust procedures to confirm a client's status. Failing to conduct this verification exposes the firm to the risk of misclassification and noncompliance, as the firm has not met its obligation to reasonably ascertain the client's true status. Professionals should employ a decision-making framework that begins with a thorough understanding of the regulatory definitions of retail and institutional customers as defined by the CFTC and NFA. This framework should involve gathering objective information about the client's business, assets, and trading experience, and then applying the regulatory criteria to make a classification. If there is any ambiguity, it is prudent to err on the side of caution and treat the client as retail, ensuring all applicable protections are provided, or to seek clarification from regulatory bodies or legal counsel. Question 3. Cost-benefit analysis shows that educating retail clients on the fundamental components of Forex currency pairs is paramount for informed trading. In the context of retail off-exchange Forex trading in the United States, if a client asks for a clear explanation of the terms base currency and quote currency within a currency pair like EUR/USD, which of the following explanations best serves to prevent misunderstanding and ensure compliance with regulatory expectations for clarity? Option A. The base currency is the one you want to buy, and the quote currency is the one you are selling. Option B. The base currency is the first currency listed in a currency pair, and the quote currency is the second. The quote currency tells you how much of it is needed to buy 1 unit of the base currency. Option C. The base currency is always the stronger currency in the pair, and the quote currency is always the weaker one. Option D. The terms currency is the one that determines the value, and the secondary currency is the one being exchanged for it. Correct answer is B. The base currency is the first currency listed in a currency pair, and the quote currency is the second. The quote currency tells you how much of it is needed to buy 1 unit of the base currency. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a nuanced understanding of currency pair terminology beyond simple identification. A retail client new to Forex trading might easily confuse the roles of base and quote currencies, especially when presented with different trading contexts. Misunderstanding these terms can lead to incorrect trade execution, misinterpretation of market movements, and ultimately, financial losses. The challenge lies in ensuring the client grasps the fundamental concept of which currency is being bought or sold relative to another, which is crucial for informed decision-making in the Forex market. Correct approach analysis. The best professional approach involves clearly defining the base currency as the first currency in a pair and the quote currency as the second. It emphasizes that the quote currency represents the price or value of the base currency. This approach is correct because it directly addresses the client's potential confusion by providing a foundational definition that applies universally to all currency pairs. This clarity aligns with the ethical obligation to educate clients and ensure they understand the products they are trading, as mandated by regulatory bodies like the National Futures Association, NFA, in the United States, which oversees retail off-exchange Forex transactions. Providing this fundamental definition empowers the client to interpret any currency pair correctly. Incorrect approach is analysis. One incorrect approach is to simply state that the base currency is the one the client wants to buy, and the quote currency is the one they want to sell. This is ethically flawed because it oversimplifies the concept and can be misleading. In a Forex transaction, a client might be buying the base currency and selling the quote currency, or vice versa, depending on their trading strategy and the direction of the market. This approach fails to provide a consistent, objective definition and could lead to confusion when the client's intention doesn't neatly fit this simplistic model. It also neglects the regulatory requirement for clear and accurate disclosure of trading terms. Another incorrect approach is to focus solely on the terms currency and secondary currency as synonyms for quote currency, without first establishing the primary roles of base and quote currencies. While terms currency and secondary currency might be used in some contexts, they are not the universally accepted or primary terms for defining the components of a Forex pair. Relying on these less common terms without a solid foundation in base and quote currency definitions can further confuse a new trader. This approach is professionally deficient as it fails to use standard terminology, increasing the risk of miscommunication and misunderstanding, which is contrary to the principles of fair dealing and investor protection expected under U.S. Forex regulations. A final incorrect approach is to explain that the base currency is always the stronger currency and the quote currency is always the weaker one. This is fundamentally incorrect and ethically problematic. Currency strength fluctuates constantly based on market conditions, and this definition would be inaccurate and misleading. A currency that is considered strong at one moment could weaken significantly later. Presenting such a false definition violates the duty to provide accurate information and could lead a client to make trading decisions based on flawed premises, resulting in potential financial harm and regulatory noncompliance. Professional reasoning. Professionals should always prioritize clear, accurate, and universally applicable definitions when educating clients about financial products. The decision-making process should involve starting with the most fundamental and standard terminology, ensuring that the client builds a solid understanding from the ground up. When faced with potential client confusion, the professional's duty is to clarify using established definitions and principles, rather than resorting to oversimplifications or inaccurate analogies. This approach not only fulfills ethical obligations, but also ensures compliance with regulatory requirements for investor education and fair practice. Question 4. System analysis indicates a retail foreign exchange dealer registered in California is explaining the pricing of a forward Forex contract to a client. The dealer needs to convey the nature of forward points accurately. Which of the following explanations best adheres to regulatory requirements and professional ethics in the United States? Option A. Forward points are a service charge added by the firm for facilitating the forward transaction. Option B. Forward points are simply an additional amount added to the spot rate to determine the forward rate. Option C. Forward points are not relevant to the client's understanding of the final transaction cost. Option D. Forward points represent the interest rate differential between the two currencies being traded, adjusting the spot rate to arrive at the forward rate, and are not a fee charged by the firm. The correct answer is D. Forward points represent the interest rate differential between the two currencies being traded, adjusting the spot rate to arrive at the forward rate, and are not a fee charged by the firm. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a retail foreign exchange dealer, RFED, registered in California to accurately communicate the implications of forward points to a client. Misunderstanding or misrepresenting forward points can lead to significant financial discrepancies for the client and potential regulatory violations for the RFED. The challenge lies in translating a technical concept into clear, actionable information that the client can understand and use for their trading decisions, while adhering to the stringent disclosure requirements of the Commodity Futures Trading Commission, CFTC, and the National Futures Association, NFA, in the United States. Correct approach analysis. The best professional practice involves clearly explaining that forward points represent the difference between the spot exchange rate and the forward exchange rate, reflecting the interest rate differential between the two currencies. This explanation should also explicitly state that these points are not a fee or commission charged by the RFED, but rather a market-driven adjustment. This approach is correct because it provides the client with a transparent and accurate understanding of the pricing mechanism, fulfilling the regulatory obligation to ensure customers are not misled about the costs and mechanics of their trades. It aligns with CFTC Rule 171 and NFA Interpretive Notice 03-07, which emphasize fair dealing and preventing deceptive practices. Incorrect approach is analysis. One incorrect approach is to describe forward points as a cost of doing business or a service charge levied by the RFED. This is ethically problematic and potentially violates CFTC regulations against misrepresentation, as it falsely attributes a market-based adjustment to a firm-specific fee. Another incorrect approach is to simply state that forward points are added to the spot rate without explaining their origin or purpose. This lacks the necessary transparency and educational component required for informed consent, potentially leading the client to believe it's an arbitrary charge. Finally, omitting any mention of forward points and only discussing the final forward rate is also a failure, as it obscures a crucial component of the pricing that directly impacts the client's trade. This lack of disclosure can be seen as a violation of the duty to provide accurate and complete information. Professional reasoning. Professionals should adopt a framework of transparency and client education. When discussing pricing mechanisms like forward points, the process should involve 1. Identifying the specific component being discussed, forward points. 2. Explaining its market origin, interest rate differentials. 3. Clarifying its impact on the final rate. 4. Explicitly stating it is not a firm-specific fee. 5. Ensuring the client understands this information before proceeding with the trade. This proactive and educational approach minimizes the risk of misunderstanding and ensures compliance with regulatory expectations for fair and honest dealing. Question 5. Risk assessment procedures indicate that a retail foreign exchange dealer, RFED, registered in the United States has an affiliated futures commission merchant, FCM. Which of the following approaches best ensures the RFED compliance with the Commodity Exchange Act and CFTC regulations regarding customer funds and disclosures? Option A. Relying on the affiliated FCM's existing compliance framework to cover all regulatory requirements for the RFED retail Forex customers. Option B. providing general disclosures to retail Forex customers about the existence of an affiliated FCM without detailing specific fund handling or risk implications. Option C. Developing and implementing comprehensive internal policies and procedures that clearly define the RFED responsibilities concerning customer fund segregation and risk disclosures related to its affiliation with the FCM. Option D. Commingling the RFED retail Forex customer funds with its own operating capital, assuming the FCM segregation practices will indirectly protect these funds. Correct answer is C. Developing and implementing comprehensive internal policies and procedures that clearly define the RFED responsibilities concerning customer fund segregation and risk disclosures related to its affiliation with the FCM. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a retail foreign exchange dealer, RFED, in the United States to navigate the complex regulatory landscape concerning its interactions with other regulated entities, specifically a Futures Commission merchant, FCM. The core challenge lies in ensuring that the RFED business practices and disclosures fully comply with the Commodity Exchange Act, C, and relevant CFTC regulations, particularly regarding the segregation of customer funds and the avoidance of conflicts of interest when dealing with an affiliated FCM. Misinterpreting or inadequately addressing these relationships can lead to significant regulatory violations, financial penalties, and reputational damage. Correct approach analysis. The best professional practice involves the RFED establishing and maintaining robust internal policies and procedures that explicitly address its relationship with the affiliated FCM. This includes clear guidelines on how customer funds are handled, how transactions are processed, and how potential conflicts of interest are identified and mitigated. Specifically, the RFED must ensure that customer funds are segregated in accordance with CFTC regulations, and that any disclosures made to retail Forex customers accurately reflect the nature of the relationship with the FCM and the associated risks. This approach is correct because it proactively addresses regulatory requirements under the CEA, such as those pertaining to customer protection and the operational integrity of registered entities. It demonstrates a commitment to compliance and risk management, aligning with the principles of responsible conduct expected of an RFED. Incorrect approaches analysis. One incorrect approach involves the RFED assuming that because the affiliated FCM is also a regulated entity, all regulatory obligations related to customer funds and disclosures are automatically satisfied by the FCM's compliance. This is a failure because the CEA imposes specific duties on RFED regarding their own operations and customer interactions, even when dealing with affiliated entities. The RFED cannot delegate its primary compliance responsibilities. Another incorrect approach is for the RFED to provide generic disclosures to its retail Forex customers about its relationship with the FCM, without detailing how customer funds are handled or the specific risks associated with transacting through an affiliated FCM. This is a regulatory and ethical failure because it lacks the specificity required by CFTC rules for adequate disclosure, potentially misleading customers about the protections afforded to their funds and the nature of the counterparty. A further incorrect approach is for the RFED to commingle customer funds with its own operating funds, believing that the FCM's segregation of its own customer funds will indirectly protect the RFED customers. This is a direct violation of the CEA and CFTC regulations concerning the segregation of customer funds by RFED. Each registered entity has distinct obligations for safeguarding customer assets. Professional reasoning. Professionals should adopt a proactive and meticulous approach to regulatory compliance. This involves thoroughly understanding the specific obligations imposed by the CEA and CFTC regulations on their particular registration category, e.g., RFED. When dealing with affiliated regulated entities like FCMs, professionals must conduct a detailed analysis of intercompany agreements and operational flows to ensure that all customer protection requirements are met at every level. Regular internal audits and compliance reviews, coupled with ongoing training for staff, are essential to identify and address potential gaps in compliance before they lead to violations. The decision-making process should prioritize transparency with customers and adherence to the spirit and letter of the law. Question 6. Compliance review shows that a registered person in California is explaining a retail foreign exchange transaction involving USD/CAD to a client. The current market rate is approximately 3,500. Which of the following explanations best ensures the client understands the transaction's terms? Option A. The USD/CAD rate is 3,500. Option B. The USD/CAD rate is 3,500, meaning it will cost you 3,500 Canadian dollars to buy $1. Option C. The USD/CAD rate is 3,500, meaning it will cost you 7,407 dollars to buy $1 Canadian dollar. Option D. The USD/CAD is trading at 3,500. Correct answer is B. The USD/CAD rate is 3,500, meaning it will cost you 3,500 Canadian dollars to buy $1. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a registered person to accurately communicate the terms of a foreign exchange transaction to a client, ensuring the client fully understands the pricing convention used. Misinterpreting or miscommunicating these terms can lead to significant client dissatisfaction, potential financial losses for the client, and regulatory scrutiny for the firm and the individual. The core challenge lies in translating the abstract concept of American terms and European terms into a clear, actionable understanding for a retail client, especially when dealing with a specific currency pair like USD/CAD. Correct approach analysis. The best professional practice involves clearly stating the currency pair and then explicitly defining the quoted price in relation to the base currency, using the terminology the client is most likely to understand or by providing a direct explanation. For USD/CAD, stating the rate as 3,500 Canadian dollars per US dollar directly explains the value of $1 in terms of Canadian dollars. This approach aligns with the principle of clear and fair dealing mandated by regulatory bodies, ensuring the client understands the cost or value of the transaction from their perspective. It avoids ambiguity by directly linking the quote to the base currency, USD, and expressing it in the terms of the quote currency, CAD. Incorrect approach is analysis. Quoting the rate as 7,407 US dollars per Canadian dollar is incorrect because it uses European terms for a pair that is conventionally quoted in American terms in the US retail market. While mathematically equivalent, it can confuse a client accustomed to American terms and may not accurately reflect the firm's standard disclosure practices for this specific market. This can lead to a misunderstanding of the transaction's value. Stating the rate as 3,500 without specifying the currency pair or the relationship between the currencies is professionally deficient. This omission creates significant ambiguity. The client does not know which currency is being quoted against which, nor the direction of the quote, e.g., how many CAD for one USD or how many USD for one CAD. This lack of clarity violates the duty to provide accurate and understandable information. Simply stating the USD/CAD is trading at 3,500 is also insufficient. While it identifies the currency pair, it fails to explain what that number represents in practical terms for the client. The client needs to know if 3,500 means they are buying USD at that rate or selling USD at that rate, and what that means in terms of the other currency. This approach lacks the necessary detail to ensure client comprehension. Professional reasoning. Professionals should always prioritize clarity and client understanding when communicating financial terms. This involves not only knowing the technical definitions of terms like American and European conventions, but also being able to translate them into plain language relevant to the client's transaction. When dealing with currency pairs, explicitly stating the base and quote currencies and defining the rates meaning, e.g., X units of quote currency per 1 unit of base currency, is paramount. Firms should have clear internal policies on how to present such information to retail clients, and registered persons must adhere to these policies and the overarching regulatory duty of fair dealing. When in doubt, err on the side of over-explanation to ensure client comprehension. Question 7. System analysis indicates a registered representative in California has received an inquiry from a retail client who is new to off-exchange Forex trading and is asking about the costs associated with entering and exiting trades. The representative needs to explain the concept of the bid-ask spread. Which of the following explanations best addresses the client's concern while adhering to regulatory requirements. Option A. Explain that the bid-ask spread is the difference between the price at which the firm will buy a currency pair, the bid, and the price at which the firm will sell it, the ask, and that this difference represents a direct cost incurred by the client on each trade. Option B. Assure the client that the bid-ask spread is a minor cost that can usually be overcome by even small price fluctuations in their favor. Option C. State that the bid-ask spread is simply how the firm generates revenue from client transactions, and that clients should focus on market movements to profit. Option D. Inform the client that the bid-ask spread is a negotiable fee that can often be reduced or eliminated with sufficient trading volume. The correct answer is A. Explain that the bid-ask spread is the difference between the price at which the firm will buy a currency pair, the bid, and the price at which the firm will sell it, the ask, and that this difference represents a direct cost incurred by the client on each trade. Explanation. Scenario analysis. This scenario presents a professional challenge for a registered representative in California dealing with a retail client's inquiry about Forex trading costs. The core difficulty lies in accurately and transparently communicating the impact of the bid-ask spread, a fundamental component of trading costs, without misleading the client or violating regulatory disclosure requirements under California and U.S. federal law. The representative must balance providing helpful information with avoiding the implication of guaranteed profits or downplaying inherent risks. Correct approach analysis. The best professional approach involves clearly explaining that the bid-ask spread represents the difference between the price at which a dealer will buy a currency pair, the bid, and the price at which they will sell it, the ask. This difference is a direct cost of trading, as a client buying the base currency will pay the higher ask price, and a client selling it will receive the lower bid price. This explanation aligns with the principles of fair dealing and transparency mandated by FINRA rules and the Commodity Futures Trading Commission, CFTC, regulations applicable to retail off-exchange Forex transactions in the United States. It educates the client on a key cost factor without making specific profit projections or guarantees, thereby fulfilling the duty to provide accurate and understandable information. Incorrect approach is analysis. One incorrect approach is to simply state that the spread is how the firm makes money without further elaboration. This is insufficient as it lacks transparency and does not adequately educate the client on the direct impact of this cost on their potential trading outcomes. Risks the client underestimating the actual cost of entering and exiting trades. Another incorrect approach is to focus solely on the potential for price movements to overcome the spread, implying that the spread is easily negated. This is misleading and can create an unrealistic expectation of profitability, potentially violating anti-fraud provisions and the duty to avoid misrepresentation. Finally, an approach that dismisses the spread as a minor factor or suggests it is negotiable in retail Forex transactions is also incorrect. The bid-ask spread is a standard and unavoidable cost in off-exchange Forex trading, and minimizing its significance or suggesting it can be easily waived misrepresents the market realities and regulatory framework. Professional reasoning. Professionals should approach client inquiries about trading costs by prioritizing clarity, accuracy, and regulatory compliance. This involves understanding the fundamental components of trading costs, such as the bid-ask spread, and being able to explain them in plain language. The decision-making process should always begin with identifying the client's specific question, and then formulating a response that is both informative and compliant with all applicable regulations, including those governing fair dealing, disclosure, and the prevention of misleading statements. The representative must always act in the best interest of the client, which includes ensuring they have a realistic understanding of the costs and risks involved in trading. Question 8. System analysis indicates that a retail client of a United States-based Futures Commission merchant, FCM, holding an off-exchange Forex position, has experienced a significant market movement against their position, resulting in their account equity falling below the required minimum margin level. The FCM's risk management system has flagged this deficit. What is the most appropriate and compliant course of action for the FCM to take immediately? Option A. Wait for the market to potentially reverse or for the client to voluntarily deposit more funds before taking any action on the margin shortfall. Option B. Accept a less liquid non-standard asset from the client as collateral to cover the margin deficit, bypassing standard valuation procedures. Option C. Cover the margin shortfall internally with the firm's own capital and not inform the client or seek additional collateral. Option D. Issue a margin call to the client for the precise amount needed to restore the account to the minimum margin requirement. Correct answer is D. Issue a margin call to the client for the precise amount needed to restore the account to the minimum margin requirement. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent volatility of foreign exchange markets and the critical need to protect both the client's assets and the firm's financial stability. Mismanaging collateral and margin requirements can lead to significant financial losses, regulatory sanctions, and reputational damage. The firm must navigate the complexities of margin calls, collateral valuation, and segregation requirements under the Commodity Futures Trading Commission (CFTC) regulations for retail off-exchange Forex transactions in the United States. Correct approach analysis. The best professional practice involves promptly issuing a margin call to the client for the exact amount required to bring the account back to the minimum margin level, as stipulated by the firm's risk management policies and CFTC regulations. This approach ensures that the client's account is adequately secured, mitigating the risk of further losses for both parties. It directly addresses the shortfall in collateral, adhering to the principle of maintaining sufficient security for leveraged positions. This is compliant with CFTC Rule 1.17, which mandates that FCMs and introducing brokers maintain adequate capital and segregation of customer funds and property, including collateral. Incorrect approaches analysis. One incorrect approach is to delay issuing the margin call until the market moves further against the client, hoping the client will deposit additional funds voluntarily or that the market will reverse. This is a failure to act promptly and proactively manage risk. It violates the principle of prudent risk management and can expose the firm to greater losses if the market continues to move unfavorably. Furthermore, it may be seen as a breach of the firm's duty to protect customer assets by not enforcing necessary margin requirements in a timely manner. Another incorrect approach is to accept a less liquid or non-standard asset as collateral without proper valuation and approval, even if it appears to cover the margin deficit. This bypasses established risk management protocols and could result in the collateral being difficult to liquidate or worth less than anticipated, leaving the firm under-collateralized. This is contrary to the spirit of CFTC regulations that emphasize the integrity and liquidity of customer assets and collateral. A third incorrect approach is to absorb the margin shortfall internally without notifying the client or seeking additional collateral. This is a serious regulatory and ethical breach. It misrepresents the client's account status, potentially violates segregation requirements by commingling firm capital with customer margin, and fails to adhere to the firm's own risk management policies. Such an action could be construed as an unauthorized extension of credit or a violation of capital requirements under CFTC rules. Professional reasoning. Professionals should adopt a systematic approach to margin management. This involves continuous monitoring of client positions and market movements, understanding the firm's margin policies and applicable CFTC regulations, and having clear procedures for issuing and responding to margin calls. When a margin shortfall occurs, the immediate priority is to enforce the margin requirements as per established protocols. This includes accurate calculation of the required collateral, prompt communication with the client, and proper documentation of all actions taken. If the client fails to meet the margin call, the firm must follow its procedures for liquidation of positions to protect itself and the client from further losses, always acting in accordance with regulatory requirements. Question 9. System analysis indicates a retail foreign exchange dealer in California is discussing a potential trade with a client. The dealer intends to quote the USD/MXN currency pair. Considering the regulatory environment and the need for client protection, which of the following approaches best ensures the client understands the transaction? Option A. Refer to the pair by its common nickname, the peso, assuming the client knows it's against the US dollar. Option B. Quote the pair simply as USD/MXN. Option C. State the pair as US dollar versus Mexican peso, assuming the client understands that USD is the base currency and MXN is the quote currency. Option D. Clearly state the currency pair as US dollar versus Mexican peso. The correct answer is D. Clearly state the currency pair as US dollar versus Mexican peso. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a retail foreign exchange dealer in California to navigate the complexities of currency pair quotation and client understanding in a way that is both compliant with U.S. regulations and ethically sound. The challenge lies in ensuring that the client fully comprehends the nature of the quoted currency pair, particularly when dealing with less common or emerging market currencies, to prevent misunderstandings that could lead to financial losses or disputes. The dealer must balance the need for efficient trading with the paramount duty of client protection and transparency. Correct approach analysis. The best professional practice involves clearly and explicitly stating both the base currency and the quote currency when discussing a currency pair with a client, especially when the quote currency is not USD. This approach ensures maximum clarity and minimizes the risk of client confusion. For example, when discussing USD/MXN, the dealer should state US dollar versus Mexican peso. This aligns with the regulatory expectation under the Commodity Futures Trading Commission, CFTC, and National Futures Association, NFA, rules that retail foreign exchange transactions be conducted with transparency and that clients are not misled. Ethical considerations also demand that dealers act in the best interest of their clients, which includes ensuring they understand the products they are trading. Incorrect approaches analysis, quoting a currency pair solely by its ticker symbol, e.g., USD/MXN, without further explanation, particularly if the client is not demonstrably sophisticated in Forex markets, fails to meet the standard of clear communication required by regulators. This can lead to the client misunderstanding which currency is being bought and which is being sold, or the direction of profit and loss. This approach risks violating CFTC and NFA regulations regarding fair dealing and preventing fraud and manipulation, as it relies on the client's pre-existing knowledge, which cannot be assumed. Referring to a currency pair by its common nickname e.g., the Aussie, without also stating the official currency names, Australian dollar and US dollar, introduces ambiguity. While common in industry parlance, such nicknames are not universally understood and can be particularly confusing for retail clients who may not be deeply immersed in Forex trading. This lack of explicit clarity can be seen as a failure to provide adequate disclosure, potentially contravening regulatory requirements for clear and accurate representation of trading instruments. Assuming the client understands that the first currency listed is always the base currency, and the second is the quote currency, without explicit confirmation or explanation, is a dangerous assumption. While this is a standard convention, a responsible dealer must ensure the client's comprehension, especially in a regulated environment like retail Forex in California. This assumption can lead to misinterpretations of exchange rates and profit/loss calculations, creating a situation where the client is not fully informed, which is a breach of ethical duty and potentially regulatory noncompliance. Professional reasoning. Professionals should adopt a client-centric communication strategy. This involves always prioritizing clarity and ensuring the client's understanding of the product being offered. When discussing currency pairs, especially those involving non-USD quote currencies or less frequently traded pairs, explicitly stating both currency names is essential. This proactive approach to disclosure, coupled with a willingness to explain terms and conventions, builds trust and ensures compliance with regulatory obligations to provide fair and transparent dealing. Professionals should always err on the side of over-explaining rather than assuming client knowledge. Question 10. Quality control measures reveal that a retail Forex broker operating in the United States has provided a client with a quote for a EUR/USD trade. The client wishes to buy EUR 100,000 at quoted rate of 1,050/1,055. The broker also charges a commission of 0.05% on the notional value of the trade. What is the total cost to the client in USD for this transaction, assuming the client buys at the ask price and sells at the bid price in a round trip? Option A. The total cost is the sum of the spread on the notional value plus the commission on the notional value, calculated as \1 1,055 1,050 times 100 000 plus 0.0005 times 100 000 times 1,055 . Option B. The total cost is the spread on the notional value plus the commission on the notional value, calculated as backslash 1, 1055 1, 1050 backslash times 100, 000 plus 0, 0005 backslash times 100, 000 backslash. Option C. The total cost is solely the spread on the notional value, calculated as backslash 1, 1055 1, 1050 backslash times 100, 000 backslash. Option D. The total cost is the commission on the notional value, calculated as backslash 0, 0005 backslash times 100, 000 backslash times 1, 1055 backslash. The correct answer is A. The total cost is the sum of the spread on the notional value plus the commission on the notional value, calculated as backslash 1, 1055 1, 1050 backslash times 100, 000 plus 0, 0005 backslash times 100, 000 backslash times 1, 1055 backslash. Explanation. Scenario analysis. This scenario presents a common challenge in retail Forex trading where a client needs to understand the true cost of a transaction beyond the stated exchange rate. The professional challenge lies in accurately calculating and communicating the total cost, ensuring transparency and compliance with regulatory requirements regarding disclosure of all fees and charges. Misrepresenting or failing to disclose these costs can lead to significant regulatory penalties and client dissatisfaction. Correct approach analysis. The best professional practice involves calculating the total cost of the transaction by considering both the spread and any explicit commission. This approach is correct because it provides the client with a comprehensive understanding of the actual expense incurred. Under the regulations governing retail off-exchange Forex in the United States, brokers are required to disclose all material costs associated with a transaction. This includes the difference between the bid and ask prices, the spread, and any additional fees or commissions charged. By calculating the total cost, the broker fulfills their obligation to provide clear and accurate information, enabling the client to make an informed decision. Incorrect approaches analysis. One incorrect approach is to only consider the stated exchange rate and ignore the spread. This is professionally unacceptable because it fails to disclose a significant component of the transaction cost. The spread represents the profit margin for the broker and directly impacts the client's effective entry and exit prices. Failing to account for it is a violation of disclosure requirements. Another incorrect approach is to only state the spread without quantifying the total cost in the client's base currency. While mentioning the spread is a step towards transparency, it does not provide the client with a clear, actionable figure for the total expense of the trade. This lack of concrete quantification can be misleading and does not fully satisfy the regulatory mandate for clear cost disclosure. A further incorrect approach is to solely focus on the commission, if any, and disregard the spread. This is also a regulatory failure as the spread is an inherent cost in any Forex transaction, whether explicit or implicit. Ignoring it presents an incomplete picture of the transaction's financial implications for the client. Professional reasoning. Professionals should always prioritize transparency and accuracy in all client communications, especially concerning transaction costs. A robust decision-making framework involves 1. Identifying all potential costs associated with a Forex transaction, including spreads, commissions, and any other fees. 2. Quantifying these costs in the client's base currency for clarity. 3. Clearly and conspicuously disclosing these total costs to the client before the transaction is executed. 4. Ensuring that all disclosures are compliant with the specific regulations of the relevant jurisdiction, in this case the United States. Question 11. Governance review demonstrates that a retail foreign exchange dealer registered in the United States is preparing new marketing materials for its clients. The firm's compliance department is reviewing the proposed content related to exchange rate movements. Which of the following approaches best reflects regulatory compliance and ethical best practices in the United States for communicating exchange rate dynamics to retail Forex clients? Option A. Emphasize the potential for significant profits by highlighting favorable past exchange rate trends, while downplaying the impact of adverse movements. Option B. Avoid detailed discussion of exchange rate mechanics, assuming clients possess a comprehensive understanding of Forex market volatility. Option C. Attribute future exchange rate movements to specific, predictable economic events, suggesting a high degree of certainty in the direction of currency pairs. Option D. Proactively educate clients about the inherent volatility of exchange rates and the potential for both gains and losses due to these fluctuations, providing clear and balanced disclosures. The correct answer is D. Proactively educate clients about the inherent volatility of exchange rates and the potential for both gains and losses due to these fluctuations, providing clear and balanced disclosures. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a firm to navigate the complexities of exchange rate fluctuations and their impact on client expectations and regulatory disclosures within the specific framework of the Commodity Futures Trading Commission, CFTC, regulations governing retail off-exchange forex in the United States. Misinterpreting or misrepresenting exchange rate dynamics can lead to client dissatisfaction, regulatory scrutiny, and potential financial losses for both the client and the firm. The firm must ensure its communications are accurate, not misleading, and comply with the CFTC anti-fraud and anti-manipulation provisions. Correct approach analysis. The best professional practice involves proactively educating clients about the inherent volatility of exchange rates and the potential for both gains and losses due to these fluctuations. This approach entails providing clear, balanced disclosures that explain how exchange rates are determined by various market forces, including economic indicators, geopolitical events, and central bank policies. It emphasizes that past performance is not indicative of future results, and that significant price swings are a normal characteristic of the forex market. This aligns with CFTC Rule 171, which requires introducing brokers and futures commission merchants to provide risk disclosures to customers, and the general principles of fair dealing and avoiding misleading statements under the Commodity Exchange Act. By focusing on transparency and client education regarding exchange rate behavior, the firm fulfills its duty to inform and protect its clients. Incorrect approaches analysis. One incorrect approach involves downplaying the impact of exchange rate volatility and focusing solely on the potential for profit. This is ethically problematic as it creates an unrealistic expectation of returns and fails to adequately inform clients of the risks involved. Could be construed as a misleading statement under the Commodity Exchange Act, potentially violating CFTC regulations that mandate fair and honest dealing. Another incorrect approach is to attribute exchange rate movements to specific, predictable future events without sufficient evidence or hedging against uncertainty. This can be seen as speculative and potentially manipulative if the firm has a vested interest in such predictions. It misrepresents the complex and often unpredictable nature of currency markets and could lead clients to make investment decisions based on flawed assumptions, violating the principle of providing accurate and non-misleading information. A further incorrect approach is to avoid discussing exchange rate dynamics altogether, assuming clients are fully aware of the risks. This passive stance fails to meet the firm's affirmative duty to disclose material risks. While clients may have some general understanding, a responsible firm must provide specific disclosures relevant to the products offered, including the inherent volatility of exchange rates in the retail off-exchange forex market, as required by regulatory guidance and ethical best practices. Professional reasoning. Professionals should adopt a proactive and transparent communication strategy. This involves understanding the regulatory requirements for disclosure, particularly regarding the inherent risks of the products offered. When discussing exchange rates, the focus should be on educating clients about the factors influencing them, the potential for volatility, and the fact that outcomes are not guaranteed. A risk-based approach, where potential downsides are clearly articulated alongside potential upsides, is paramount. This ensures that clients can make informed decisions, thereby protecting both the client and the firm from regulatory and reputational damage. Question 12. The audit findings indicate that a retail foreign exchange dealer operating under U.S. regulations has been applying varying markups and markdowns to customer trades. Which of the following approaches best demonstrates compliance with regulatory requirements concerning fair pricing and transparency in the off-exchange retail forex market? Option A. Informing customers about markups and markdowns solely after a trade has been executed, without any prior indication or explanation of the pricing structure. Option B. Implementing a clear, documented policy for determining markups and markdowns based on objective factors, ensuring these charges are reasonable and providing customers with accessible information about this pricing methodology. Option C. Disclosing the application of markups and markdowns only in the fine print of the customer agreement, without further explanation or specific details on their calculation. Option D. Applying markups and markdowns based on the firm's assessment of a customer's trading experience and the perceived profit potential of individual trades. Correct answer is B. Implementing a clear, documented policy for determining markups and markdowns based on objective factors, ensuring these charges are reasonable, and providing customers with accessible information about this pricing methodology. Explanation. The audit findings indicate a potential issue with how a retail foreign exchange dealer, RFED, in the United States is handling markups and markdowns on customer trades. This scenario is professionally challenging because it requires a nuanced understanding of regulatory expectations regarding fair pricing and transparency in the off-exchange retail Forex market, as governed by the Commodity Futures Trading Commission, CFTC, and the National Futures Association, NFA. The core challenge lies in balancing the firm's need to generate revenue with its obligation to ensure customers receive pricing that is not manipulative or deceptive. The best professional approach involves ensuring that all markups and markdowns are reasonable and consistently applied, with clear internal policies and procedures that are readily available to customers. This means that the firm must have a documented methodology for determining these charges, which should be based on objective factors such as market conditions, execution costs, and the services provided. Transparency is paramount. Customers should be informed about the potential for markups and markdowns and understand how they are calculated. This aligns with CFTC Regulation 159 and NFA Interpretive Notice 03-07, which emphasize fair dealing and the prevention of fraud and manipulation in retail Forex transactions. By adhering to a transparent and reasonable pricing structure, the firm upholds its fiduciary duty to its clients and maintains regulatory compliance, an approach that involves applying markups and markdowns arbitrarily based on perceived customer sophistication or the firm's desired profit margin for a given trade is professionally unacceptable. This practice violates the principle of fair dealing and could be construed as manipulative or deceptive under CFTC and NFA rules. Such an approach lacks objective justification and creates an uneven playing field for customers, potentially leading to significant financial harm. Another professionally unacceptable approach is to simply state that markups and markdowns are applied without providing any details on how they are determined or what factors influence them. This lack of transparency fails to meet the regulatory expectation that customers should be adequately informed about the costs associated with their trades. While the firm may be technically applying a markup, the absence of clear disclosure and a defined methodology undermines customer trust and regulatory compliance. Finally, an approach where markups and markdowns are only disclosed after the trade has been executed, without any prior indication or explanation, is also professionally unsound. This reactive disclosure prevents customers from making informed decisions before committing to a trade and can lead to disputes and regulatory scrutiny. It fails to provide the proactive transparency required to ensure fair and equitable treatment of all customers. Professionals should adopt a decision-making framework that prioritizes transparency, fairness, and adherence to regulatory requirements. This involves establishing clear, documented policies for pricing, regularly reviewing these policies for reasonableness and compliance, and ensuring that customers are fully informed about all costs associated with their trading activities. When in doubt, seeking clarification from compliance departments or legal counsel is essential to avoid potential regulatory violations and maintain ethical business practices. Question 13. The audit findings indicate that a retail off-exchange Forex introducing broker registered in the United States has been providing clients with general information about overnight financing charges on their Forex positions, but has not explicitly detailed how the underlying interest rate differential between the two currencies in a pair influences these charges. Which of the following best describes the regulatory compliance approach that should be taken by the introducing broker in the United States? Option A. Assume that clients trading Forex are sophisticated enough to understand the concept of interest rate differentials and their impact on financing charges without explicit explanation. Option B. Provide a general disclaimer about potential overnight financing charges in the client agreement, and consider further explanation only if a client raises a specific concern about such charges. Option C. Proactively educate clients about the influence of interest rate differentials on overnight financing charges, explaining how these differentials can result in credits or debits to their accounts. Option D. Only disclose the potential for overnight financing charges when a client specifically asks about the mechanics behind these charges. The correct answer is C. Proactively educate clients about the influence of interest rate differentials on overnight financing charges, explaining how these differentials can result in credits or debits to their accounts. Explanation. The audit findings indicate a potential misunderstanding of how interest rate differentials impact retail off-exchange Forex transactions in the United States, specifically concerning the disclosure obligations of introducing brokers. This scenario is professionally challenging because it requires a nuanced understanding of regulatory requirements beyond simple transaction execution, demanding proactive client education and accurate representation of financial instruments. The core of the challenge lies in ensuring clients fully comprehend the risks and potential benefits associated with interest rate differentials, which can significantly affect the profitability of their positions, especially in leveraged Forex trading. The best professional practice involves proactively educating clients about the implications of interest rate differentials on their Forex positions. This approach is correct because it aligns with the regulatory obligation under the Commodity Exchange Act (C) and the rules of the National Futures Association (NFA) to ensure that clients receive fair and accurate information regarding the products they are trading. Specifically, introducing brokers have a duty to supervise their associated persons and to ensure that clients are not misled. Disclosing the potential impact of interest rate differentials, including the possibility of overnight financing charges, swaps, or rollovers that can accrue or be credited based on these differences, is crucial for informed decision-making. This proactive disclosure helps clients understand the total cost of holding positions overnight and the potential for gains or losses beyond the simple price movement of the currency pair. An incorrect approach involves only disclosing the potential for overnight financing charges without explaining the underlying mechanism of interest rate differentials. This fails to provide clients with a complete understanding of why these charges occur and how they can fluctuate. It is a regulatory failure because it omits essential information that could influence a client's trading strategy and risk assessment, potentially violating the NFA's anti-fraud and anti-manipulation rules, which require fair dealing with customers. Another incorrect approach is to assume that clients understand interest rate differentials inherently due to the nature of Forex trading. This assumption is a significant regulatory and ethical lapse. The CEA and NFA rules mandate clear and understandable disclosures. Relying on client assumptions bypasses the broker's responsibility to ensure comprehension, leading to potential client dissatisfaction and regulatory scrutiny for failing to provide adequate information. Finally, an incorrect approach is to only mention interest rate differentials in the context of specific trade executions when requested by the client. This reactive stance is insufficient. The regulatory framework emphasizes a proactive duty to inform and educate clients about material risks and characteristics of the products offered. Waiting for a client to inquire about interest rate differentials means that clients may have already incurred unexpected costs or missed potential benefits without full awareness, constituting a failure in the duty of care and fair dealing. Professionals should adopt a decision-making framework that prioritizes client understanding and regulatory compliance. This involves a thorough review of all applicable regulations, CFTC rules, NFA rules, identifying potential areas of client confusion, like interest rate differentials, and developing clear, concise, and proactive disclosure materials and educational programs. Regular training for associated persons on these disclosures and ongoing monitoring of client interaction are essential to ensure that the firm consistently meets its regulatory obligations and ethical standards. Question 14. Process analysis reveals that a retail foreign exchange dealer in California is discussing a forward contract with a client. The dealer quotes a bid forward rate for a currency. Which of the following best describes the dealer's professional obligation in this situation under California regulations? Option A. The dealer must explain that the bid forward rate is the price at which the dealer is willing to buy the currency at a future date, and that this rate is subject to market conditions and interest rate differentials, advising the client to consider potential market fluctuations. Option B. The dealer should highlight the potential profit the client could make using the bid forward rate, without detailing the rate's specific meaning or associated risks. Option C. The dealer should present the bid forward rate as a guaranteed future exchange rate for the client's transaction. Option D. The dealer should simply state the bid forward rate to the client without further explanation, assuming the client understands its implications. The correct answer is A. The dealer must explain that the bid forward rate is the price at which the dealer is willing to buy the currency at a future date, and that this rate is subject to market conditions and interest rate differentials, advising the client to consider potential market fluctuations. Explanation. Process analysis reveals that understanding forward rates, particularly bid forward rates, is crucial for retail foreign exchange dealers operating in California. This scenario is professionally challenging because it requires a dealer to accurately interpret and communicate the implications of forward rates to clients, ensuring that the client's understanding aligns with the dealer's obligations under California's regulatory framework for retail foreign exchange. Misinterpreting or misrepresenting these rates can lead to client dissatisfaction, regulatory scrutiny, and potential violations. The best professional approach involves a dealer clearly explaining to a retail client that the bid forward rate represents the price at which the dealer is willing to buy a currency in the future, and that this rate is influenced by factors such as interest rate differentials and market expectations. The dealer must emphasize that this rate is not a guaranteed future spot rate, and that the client should consider the potential for market fluctuations. This approach is correct because it adheres to the principles of fair dealing and transparency mandated by California's regulatory framework, which requires dealers to provide accurate and understandable information to retail clients regarding the terms of Forex transactions. Specifically, California law emphasizes the importance of clear communication about the nature of financial products and the risks associated with them. An incorrect approach would be for the dealer to simply state the bid forward rate without any explanation of its meaning or the factors influencing it. This fails to meet the regulatory requirement for clear and adequate disclosure, potentially misleading the client into believing the rate is fixed or guaranteed. Another incorrect approach is for the dealer to present the bid forward rate as a guaranteed future exchange rate. This is a direct misrepresentation and violates the duty of honesty and fair dealing, as forward rates are subject to market volatility and are not guarantees. Finally, an incorrect approach would be for the dealer to focus solely on the potential profit for the client, without adequately explaining the bid forward rate's implications and associated risks. This prioritizes sales over client understanding and protection, which is contrary to regulatory expectations for responsible conduct. Professionals should employ a decision-making framework that prioritizes client education and transparency. This involves first understanding the client's knowledge level and then tailoring explanations accordingly. When discussing forward rates, professionals should always explain what the rate signifies, the underlying market dynamics, and the inherent risks. This proactive approach ensures compliance with regulatory mandates for fair dealing and fosters trust with clients. Question 15. The control framework reveals a situation where a retail client in California is inquiring about how interest rate differentials between countries might affect their potential returns in off-exchange Forex trading. Which of the following represents the most appropriate method for addressing this client's inquiry? Option A. State that interest rate parity is too complex for retail traders and has no bearing on their off-exchange Forex transactions. Option B. Explain interest rate parity as a theoretical concept that influences currency valuations, highlighting that while higher interest rates can theoretically support a currency, actual exchange rates are affected by many factors and future movements are not guaranteed. Option C. Present interest rate parity as a precise mathematical model that dictates future exchange rates and recommend trading strategies based solely on this model. Option D. Advise the client to invest in currencies of countries with higher interest rates, suggesting this will lead to guaranteed profits through the interest rate differential. The correct answer is B. Explain interest rate parity as a theoretical concept that influences currency valuations, highlighting that while higher interest rates can theoretically support a currency, Actual exchange rates are affected by many factors and future movements are not guaranteed. Explanation. The control framework reveals a potential challenge in advising a client on retail off-exchange Forex transactions in California, specifically concerning the implications of interest rate differentials on expected returns. The professional challenge lies in accurately conveying the theoretical concept of interest rate parity without making guarantees or predictions about future market movements, which could be misconstrued as a guaranteed profit or a specific outcome. This requires a nuanced understanding of the regulatory environment governing advice on Forex products. The best approach involves educating the client on the theoretical underpinnings of interest rate parity as a concept that influences currency valuations, emphasizing that it is a theoretical equilibrium and not a predictive tool. This means explaining that while higher interest rates in one country relative to another theoretically suggest a strengthening of that country's currency to offset the interest rate differential, actual market outcomes are influenced by numerous other factors and are not guaranteed. This aligns with regulatory requirements in California that prohibit misrepresentation and require clear, accurate, and balanced information to be provided to retail investors, particularly concerning speculative products like Forex. The focus is on imparting knowledge about a market dynamic rather than predicting its effect on the client's specific investment. An incorrect approach would be to suggest that a client should invest in a currency solely because its country has a higher interest rate, implying a guaranteed profit from the interest rate differential. This fails to acknowledge the other components of interest rate parity, such as expected exchange rate movements, and ignores the inherent volatility and risks of the Forex market. Such advice could be construed as a prediction of future performance or a guarantee of profit, which is a violation of regulations prohibiting misleading statements and potentially constitutes an unsuitable recommendation. Another professionally unacceptable approach would be to dismiss the concept of interest rate parity entirely, stating it is irrelevant to retail Forex trading. This demonstrates a lack of understanding of fundamental market drivers and fails to provide the client with a comprehensive overview of factors that can influence currency prices. While not a direct misrepresentation, it is an incomplete and potentially misleading omission of relevant information, hindering the client's ability to make informed decisions. Finally, presenting interest rate parity as a definitive formula that will dictate future exchange rates and advising the client to trade based on this singular factor is also problematic. This oversimplifies a complex market and can lead to the client believing in a deterministic outcome, which is contrary to the speculative nature of Forex trading and the multitude of factors that influence currency values. This approach risks creating unrealistic expectations and could be seen as providing investment advice that is not based on a holistic assessment of risk and return. Professionals should adopt a decision-making process that prioritizes client education and risk disclosure. This involves understanding the theoretical concepts relevant to the products being discussed, such as interest rate parity, and then translating these concepts into clear, understandable language for the client. The focus must always be on explaining the potential influences on currency values and the associated risks, rather than making predictions or guarantees. Adherence to California's regulatory framework, which emphasizes fair dealing and prohibits deceptive practices, is paramount. Question 16. Stakeholder feedback indicates a registered representative in California is considering recommending a retail off-exchange Forex trade involving the AUD/JPY currency cross to a client who has previously traded EUR/USD. The client has expressed interest in diversifying their Forex portfolio and has indicated a general comfort with leveraged trading. What is the most appropriate course of action for the representative to ensure compliance with U.S. regulations governing retail off-exchange Forex transactions? Option A. Provide the client with a standard, generic risk disclosure document for leveraged Forex trading and proceed with the trade if the client signs it. Option B. Advise the client that trading the AUD/JPY cross is too complex for their current level of experience and suggest they stick to more common currency pairs like EUR/USD. Option C. Conduct a detailed discussion with the client specifically outlining the unique risks and complexities of trading the AUD/JPY currency cross, including how movements in both the Australian dollar and the Japanese yen, as well as their relationship to the US dollar, can impact the trade, and document this conversation thoroughly. Option D. Proceed with recommending the AUD/JPY trade, assuming the client's prior experience with your/USD and general comfort with leverage implies an understanding of all currency cross risks. The correct answer is C. Conduct a detailed discussion with the client specifically outlining the unique risks and complexities of trading the AUD/JPY currency cross, including how movements in both the Australian dollar and the Japanese yen, as well as their relationship to the US dollar, can impact the trade, and document this conversation thoroughly. Explanation: this scenario presents a professional challenge because it requires a registered representative to navigate the complexities of currency crosses, specifically the AUD/JPY cross, while adhering to the stringent regulatory framework governing retail off-exchange forex trading in the United States. The challenge lies in ensuring that the client's understanding and risk tolerance are accurately assessed, and that the proposed trading strategy, even if seemingly straightforward, is fully explained in the context of its inherent risks, particularly those amplified by currency crosses. The representative must balance the client's interest in potential profit with the regulatory obligation to prevent fraud, manipulation, and deceptive practices. The best approach involves a thorough and documented discussion with the client about the specific risks associated with the AUD/JPY cross. This includes explaining how movements in both the Australian dollar AUD and the Japanese yen JPY independently, as well as their combined relationship, can impact the trade's outcome. The representative must ensure the client understands that the AUD/JPY is a composite of two currency pairs, AUD/USD and USD/JPY, and that the risk profile is not simply the sum of its parts, but can be more complex due to intermarket correlations and independent economic factors affecting each currency. This detailed explanation, tailored to the client's experience level and documented, aligns with the Commodity Futures Trading Commission, CFTC regulations, and the National Futures Association, NFA, interpretive notices, which mandate that registrants must have a reasonable basis to believe that a recommendation is suitable for the customer and that customers understand the risks involved. An incorrect approach would be to proceed with the trade based solely on the client's expressed interest, without a detailed risk disclosure specific to the AUD/JPY cross. This fails to meet the suitability requirements and could be construed as a deceptive practice, as the client may not fully grasp the unique risks of trading this particular currency cross. Another incorrect approach is to assume that because the client has traded other currency pairs, they automatically understand the nuances of the AUD/JPY. Each currency cross has its own volatility, liquidity, and sensitivity to different economic and geopolitical events, and this assumption bypasses the due diligence required by regulators. Finally, providing only a generic risk disclosure that does not specifically address the complexities of currency crosses, such as the AUD/JPY, is insufficient. The representative has a duty to educate the client on the specific risks of the product being recommended. Professionals should employ a decision-making framework that prioritizes client understanding and regulatory compliance. This involves 1. Assessing the client's knowledge and experience with forex trading, particularly with currency crosses. 2. Clearly and comprehensively explaining the specific risks of the proposed currency cross, using plain language and avoiding jargon. 3. Documenting all discussions, recommendations, and client acknowledgments. And 4. Ensuring that the client's investment objectives and risk tolerance are genuinely aligned with the proposed trade. Question 17. Stakeholder feedback indicates that some retail off-exchange forex dealers in Ontario, Canada, are facing challenges in explaining the concept of the spot rate to their clients. Specifically, clients are sometimes confused about why the rate they see on a dealer's platform may differ from the rate at which their trade is ultimately executed, or why rates appear to change so rapidly. Considering the regulatory framework in Ontario, which of the following approaches best addresses this challenge while upholding regulatory obligations? Option A. Consistently quote a slightly more favorable spot rate to clients than what is actually available in the interbank market, absorbing the difference as an implicit fee, and inform clients that this is a standard practice for providing competitive pricing. Option B. Proactively educate clients that the spot rate is a real-time fluctuating market price that is subject to immediate change until trade execution, and ensure that the final execution price reflects the prevailing market rate at the moment of trade confirmation, with any spread clearly disclosed. Option C. Provide clients with historical spot rates when they inquire about current trading opportunities, explaining that these rates offer a good indication of market trends. Option D. Inform clients that the spot rate quoted at the time of their inquiry will be held firm for a period of 1 hour, regardless of subsequent market movements, to provide them with price certainty. The correct answer is B. Proactively educate clients that the spot rate is a real-time, fluctuating market price that is subject to immediate change until trade execution, and ensure that the final execution price reflects the prevailing market rate at the moment of trade confirmation, with any spread clearly disclosed. Explanation: this scenario presents a professional challenge because it requires a firm to navigate the nuances of retail off-exchange forex trading in Ontario, Canada, while ensuring client understanding and adherence to regulatory expectations regarding the spot rate. The core difficulty lies in communicating the dynamic nature of the spot price and its implications for client transactions without resorting to misleading simplifications or engaging in practices that could be construed as price manipulation or misrepresentation under Ontario Securities Commission (OSC) regulations. Careful judgment is required to balance commercial interests with the paramount duty of client protection. The best approach involves proactively educating clients about the concept of the spot rate as a real-time, fluctuating market price. This includes clearly stating that the quoted spot rate is indicative and subject to immediate change until a trade is executed and confirmed. Furthermore, it necessitates providing clients with access to the most current available spot rates at the time of their inquiry, and ensuring that the final execution price reflects the prevailing market rate at the moment of trade confirmation, with any spread clearly disclosed. This approach aligns with OSC Rule 31-505 Conditions of Registration and the general principles of fair dealing and client disclosure mandated by securities law in Ontario. It prioritizes transparency and ensures clients are making informed decisions based on accurate, albeit dynamic, pricing information. An incorrect approach would be to consistently quote a slightly more favorable spot rate to clients than what is actually available in the interbank market, with the intention of absorbing the difference as an implicit fee. This practice, while potentially attractive to clients in the short term, constitutes a misrepresentation of the true spot price and violates the duty of fair dealing. It obscures the actual cost of the transaction and can be seen as an undisclosed markup, which is prohibited under OSC regulations. Another incorrect approach is to inform clients that the spot rate is fixed for a specific period, e.g., an hour, after they inquire, even if market conditions change significantly during that time. This creates a false sense of price certainty and can lead to clients executing trades at a rate that is no longer reflective of the current market, potentially disadvantaging them. This misrepresentation of the spot price and its volatility is a breach of disclosure obligations. Finally, an incorrect approach would be to only provide clients with historical spot rates when they inquire about current trading opportunities. This fails to equip clients with the necessary information to make timely and informed decisions about entering into a spot forex transaction, as the spot rate is inherently a real-time indicator. Relying solely on historical data for current transactions is a failure to provide relevant and up-to-date pricing information. Professionals should adopt a decision-making framework that prioritizes client understanding and regulatory compliance. This involves 1. Identifying the core regulatory obligations related to fair dealing and disclosure in the specific jurisdiction, Ontario. 2. Understanding the inherent characteristics of the product being traded, spot forex, and its dynamic pricing. 3. Developing communication strategies that are transparent, accurate, and educational. And 4. Regularly reviewing internal policies and procedures to ensure they align with current regulatory expectations and best practices for client service. Question 18. The risk matrix shows that a retail foreign exchange dealer operating in California has a significant exposure to fluctuations in the EUR/USD exchange rate. Which of the following strategies best addresses this exposure while adhering to regulatory requirements for fair dealing with retail clients? Option A. Utilize client funds to cover the costs associated with the dealer's hedging activities without prior explicit client authorization. Option B. Offset the dealer's exposure by taking opposite positions in the EUR/USD pair in the retail client order flow, without specific client consent for each transaction. Option C. Implement a separate hedging strategy using the dealer's own capital in the interbank market, with full disclosure to clients about the dealer's risk management practices. Option D. Ignore the dealer's exchange rate exposure, assuming that client trading activity will naturally balance the dealer's risk over time. The correct answer is C. Implement a separate hedging strategy using the dealer's own capital in the interbank market, with full disclosure to clients about the dealer's risk management practices. Explanation: this scenario presents a professional challenge because it requires a retail foreign exchange dealer in California to balance the need to manage its own exchange rate risk exposure with its regulatory obligations to its retail clients. The challenge lies in ensuring that risk mitigation strategies employed by the dealer do not inadvertently disadvantage or mislead clients, particularly when those clients are also exposed to exchange rate risk through their own trading activities. Careful judgment is required to implement hedging strategies that are transparent and do not create conflicts of interest or violate the principles of fair dealing. The best approach involves the dealer implementing a comprehensive hedging strategy that is clearly disclosed to clients and does not involve using client funds or positions to offset the dealer's proprietary risk. This approach is correct because it aligns with the principles of fair dealing and transparency mandated by the Commodity Futures Trading Commission (CFTC) and the National Futures Association (NFA) for retail foreign exchange dealers. Specifically, CFTC Regulation 5.6a and NFA Rule 2-36a require members to deal fairly with customers and to avoid deceptive practices. By hedging its own risks separately and transparently, the dealer upholds its fiduciary duty to its clients and avoids any appearance of impropriety or conflict of interest. An incorrect approach would be for the dealer to offset its proprietary exchange rate risk by taking opposite positions in the same currency pairs that its retail clients are trading, without explicit disclosure and consent. This is professionally unacceptable because it creates a direct conflict of interest. The dealer's incentive would be to see its clients' positions move against them, thereby reducing the dealer's own hedging costs or even generating profits from client losses, which is a violation of the duty to deal fairly and ethically. Such a practice could be construed as manipulative or deceptive under CFTC and NFA rules. Another incorrect approach would be to use client funds to cover the dealer's hedging costs without clear authorization. This is a serious regulatory and ethical failure. Client funds are held in trust and must be segregated and used solely for the benefit of the clients, not to offset the dealer's operational or proprietary risks. This would violate CFTC segregation requirements and NFA rules regarding the proper handling of customer funds. A professional decision-making process for similar situations should involve a thorough understanding of the dealer's regulatory obligations under the CFTC and NFA, particularly concerning fair dealing, transparency, and the segregation of customer funds. The dealer must first identify its own exchange rate risk exposure. Then, it should explore hedging strategies that are independent of client positions and funds. Any such strategy must be fully disclosed to clients, outlining how it might impact their trading experience or account, and client consent should be obtained where appropriate. The paramount consideration must always be the protection of client interests and adherence to regulatory requirements. Question 19. Stakeholder feedback indicates a need to reinforce understanding of core Forex terminology among retail clients trading off-exchange Forex in the United States. A client is inquiring about a transaction involving USD/CAD. Which of the following accurately describes the currency pair from a U.S. regulatory perspective? Option A. The Canadian dollar CAD is the base currency and the US dollar USD is the quote currency. Option B. The Canadian dollar CAD is the secondary currency and the US dollar USD is the quote currency. Option C. The US dollar USD is the base currency and the Canadian dollar CAD is the quote currency. Option D. The US dollar USD is the terms currency and the Canadian dollar CAD is the base currency. The correct answer is C. The US dollar USD is the base currency and the Canadian dollar CAD is the quote currency. Explanation: this scenario presents a professional challenge because it requires a clear understanding of currency pair terminology in the context of retail off-exchange Forex trading, specifically within the regulatory framework of the United States. Misinterpreting these terms can lead to miscommunication with clients, inaccurate record keeping, and potential regulatory violations. The challenge lies in applying the correct definitions to a practical client interaction, ensuring compliance with the Commodity Futures Trading Commission, CFTC, and National Futures Association, NFA guidelines. The best professional approach involves accurately identifying the base currency and quote currency in a given Forex transaction. In the context of USD/CAD, the base currency is the US dollar USD, and the quote currency is the Canadian dollar CAD. This means that one unit of the base currency, USD, is being exchanged for a certain amount of the quote currency, CAD. Understanding this fundamental concept is crucial for accurate reporting and client communication. An incorrect approach would be to confuse the base and quote currencies, perhaps identifying the Canadian dollar as the base currency and the US dollar as the quote currency. This misidentification would lead to an incorrect understanding of the transaction's value and direction, potentially causing confusion for the client and inaccurate internal records. Ethically, it demonstrates a lack of diligence and understanding of the products being traded. Another incorrect approach would be to incorrectly identify the terms currency or secondary currency. While not as central to the immediate transaction value as base and quote currencies, understanding these terms is part of a comprehensive grasp of Forex market mechanics. For instance, referring to the quote currency as the terms currency without further clarification or context could be misleading. The terms currency is generally understood as the currency in which the price is quoted, which in this case is the Canadian dollar. A secondary currency is not a standard term in this context, and its use would likely create confusion. Professionals should adopt a decision-making process that prioritizes accurate terminology and clear client communication. This involves 1. Thoroughly understanding the definitions of base currency, quote currency, and related terms as per U.S. regulatory guidance. 2. Applying these definitions rigorously to every transaction. 3. Ensuring all client communications and internal records accurately reflect the identified currencies. 4. Seeking clarification from supervisors or regulatory resources if there is any ambiguity. Question 20. The efficiency study reveals that a retail Forex broker operating in California is consistently miscalculating the settlement date for its clients' off-exchange Forex trades. The broker's internal system often uses the trade execution date as the settlement date, regardless of whether it falls on a weekend or holiday, and sometimes assumes immediate settlement for all transactions. Given the regulatory framework governing retail off-exchange Forex in the United States, which of the following methods for determining the settlement date is most compliant and professionally sound? Option A. Use the trade execution date as the settlement date for all transactions, irrespective of whether it is a business day or the standard settlement period. Option B. Identify the trade date as the date the transaction is agreed upon and calculate the settlement date as 2 business days following the trade date, ensuring that weekends and holidays are excluded from the calculation. Option C. Use the date the client verbally confirms the trade as the settlement date. Option D. Assume immediate settlement on the trade date for all retail off-exchange Forex transactions. The correct answer is B. Identify the trade date as the date the transaction is agreed upon and calculate the settlement date as 2 business days following the trade date, ensuring that weekends and holidays are excluded from the calculation. Explanation. The efficiency study reveals a recurring discrepancy in how trade date and settlement date are being handled for retail off-exchange Forex transactions in California. This scenario is professionally challenging because misinterpreting or misapplying these dates can lead to significant financial errors, regulatory noncompliance, and damage to client trust. Accurate record-keeping and timely settlement are fundamental to the integrity of financial markets and client protection, as mandated by the Commodity Futures Trading Commission, CFTC, and the National Futures Association, NFA, in the United States. The correct approach involves accurately identifying the trade date as the date the transaction is agreed upon, and the settlement date as the date when the actual exchange of funds and currency occurs. For retail off-exchange Forex, the settlement date is typically 2 business days after the trade date for most major currency pairs, unless otherwise specified in the agreement. This precise adherence ensures that all parties are aware of their obligations and the financial implications at the correct time, aligning with regulatory requirements for accurate trade recording and reporting. This approach is correct because it directly reflects the operational realities of Forex trading and the regulatory imperative for clear, unambiguous transaction timelines. An incorrect approach would be to assume the settlement date is the same as the trade date. This fails to acknowledge the inherent delay in the actual transfer of funds and currency, which is a standard practice in Forex markets. This miscalculation would lead to inaccurate financial statements, potential interest rate discrepancies, and a failure to comply with reporting requirements that rely on accurate settlement dates. Ethically, it misrepresents the financial position and obligations of the client. Another incorrect approach is to use the date the trade was executed by the trading platform as the settlement date, without considering if it was a business day or if it aligns with the standard 2 business day settlement convention. This can lead to settlement occurring on weekends or holidays, causing further complications and potential breaches of contract and regulation. It demonstrates a lack of understanding of the operational mechanics of settlement and the importance of business days. A further incorrect approach is to use the date the client confirms the trade as the settlement date. While client confirmation is important, it does not dictate the actual date of financial settlement. This approach ignores the established market conventions and regulatory expectations for settlement timing, leading to the same issues of inaccurate financial reporting and potential regulatory violations as the other incorrect methods. Professionals should employ a decision-making framework that prioritizes understanding the specific terms of the trade agreement, the standard settlement conventions for the currency pair involved, and the applicable regulatory guidance from the CFTC and NFA. This involves verifying the trade date and then calculating the settlement date based on the number of business days required for settlement, ensuring all calculations are precise and documented.